with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, January 24th, 2025. It seemed like New Year's was like ages ago, right? I mean, we're just right in the swing of things now for 2025. And what a week. Let's go and jump into it. Numbers moved higher this week by quite a bit, actually. So we saw the Dow Jones Industrial Average up 2.1% this week. The S&P 500 up 1.7%. The NASDAQ Composite up 1.6%. Russell Small Cap Index up 1.4%. So all the major indices rising higher this week. Looking at the Volatility Index, it was down 7%, down at a 14.8%, getting down in that complacent territory. Okay, so when the Volatility Index gets low, I start getting a little more concerned that we could have some volatility in front of us. I look at it as a kind of a counter type indicator. When it looks complacent, I get nervous. When it looks really crazy, I'm ready to do some buying. Look at the TLT. That's the basket of 20-year treasuries, flat on the week, flat on the year. So that's kind of good, right? Interest rates have been all over the place, and it'd be nice to kind of see things settle down on the long-term rates for sure. We'd really like to see that happen. Taking a look at different sectors throughout the market, everything except energy was positive. Some things a bit more than others. So we saw communication services up quite a bit. That includes things like Facebook and Google. Technology up 2.2%. You had industrials up 2.4% and healthcare up 2.9%. And then the big negative on the week was energy down 2.8%. We'll talk about why in just a moment. And then gold and silver, gold up 2.5%, silver up 1%. So what moved markets this week? Well, it wasn't a what, it was a who. And his name is President Donald J. Trump. And man, did he move markets. So let's talk first about energy. Like we had the inauguration speeches, and there's been lots of communication with the public this week from President Trump. But one of the big narratives has been energy. Energy. Just kind of taking the gloves off on American energy, promoting more U.S. production of energy. And the energy cohort responded negatively to that. Now, we said, why is that? Why would energy stocks be down 2.8% when you have an energy-friendly president? And the reason for that is because if you produce a lot more, then prices go down. Prices go down, your profit margins go away. And that's why they reacted a bit negatively this week. But I've got a little different hypotheses here. I do believe that energy stocks look attractive here still. I mean, look, energy prices can go lower, don't get me wrong, but I will say this. When you look around the world at global demand, it's been light. And if China can start kind of getting up and moving again from COVID, they still have not rebounded, folks, from COVID. Still haven't gotten off the mat. And they get moving again, you're going to see a big increase in demand. Europe has been a mess. If they start moving again, big increase in demand. And if our economy starts humming a little stronger, that could also increase demand. So although we would anticipate a greater production with these policies, we could also see greater demand, which could kind of keep oil prices, where they are. Maybe even have them drift a little higher is even possible. Look, year to date, they're off to a great start. We've been very, very pleased with our energy exposure. These stocks still look cheap, and I still love them. And even if we start producing more and prices come down a bit, I don't think that strips away the value that we see here in the energy space. And like I say, if global demand starts to pick up, then I think we can do very well there still moving forward. So that's one big thing. And then you had lots of other things. You had a big announcement about $500 billion being invested in the United States on this huge artificial intelligence infrastructure deal. I will say that the $500 billion number is a bit inflated at the moment. I think the anticipated investment over time is $500 billion, but I think at the start you're looking around $100 to $200 billion there from a group of investors. One of the ones being Masa-san. He's out of Japan. So that was really good. A lot of different companies responded very positively to that news. You had Trump address the group that was at Davos, Switzerland. There's a huge economic summit going on this week in Davos, Switzerland. President Trump addressed that entire group. And again, just tons of positive things to say about the markets and the economy and expectations moving forward. And markets have been responding a lot to all of these things. One thing that kind of jumped out at me, though, this week, there was a press conference, an impromptu press conference that took place the evening of the inauguration. President Trump was back in the White House, in the Oval Office, signing executive orders and fielding questions from reporters, just taking them as they came. No screening, just taking every question that came his way. One of the things that was mentioned were tariffs on Canada and Mexico, and Trump floated 25% tariff beginning February 1st. Now, I was watching the futures during this impromptu press conference, and when that was said, the stock market futures just tanked. They took a big hit. Now, they rebounded after that, and they went positive, and the next day was positive. It wasn't a long-lasting effect. But the point that I want to make to you is this. Right now, the market is rising on hopium. It's hoping that everything's going to go just wonderfully and beautifully and perfectly. But that's not how the real world works, and that's not how the economy works. And we've had a President Trump administration in the past. We know that it can be a bit volatile when things are being negotiated, right? Things are going to be said, and things are going to move markets. So if things like this come to fruition, if there is a 25% tariff on Canada and Mexico and things like this, look, you could really see the market start to get shaken up here a bit. There could be some increased volatility. So look, I think there's a lot of exciting things going on, but I also think that to get from point A to point B, it could definitely create some volatility. I think the market is ahead of itself right now. And I'll also say this, the short-term indicators all suggest that the market's ahead of itself. We got an S&P oscillator number today on Friday, well north of 5%. That's a big number. You want to be under 5. If you're over 5, sell. And if you're -5, start buying. So it's over 5. You got the DeMark indicators. I talk about those quite often on the podcast here. They're flashing 9s and 13s, suggesting that this short-term move that we've had in the market the last week and a half, 2 weeks is becoming exhausted at this point. And the intermediate term indicators are still showing some weakness. Like it's not over yet, this little correction we started having a couple of weeks ago. So I'm not convinced that the market is finished yet. I still think there's some work to do. I mentioned last week that maybe a few more days, the market might start to soften. Started to soften a little bit here on Friday as the market did have a down day today. So we'll see what comes moving forward. But I would say that to me, it looks like the market's probably going to soften a bit again. And when it does, we'll look to buy that. I don't think it's going to be anything long-term or major, but I do expect some softness. Other news this week, we have had earnings coming out. They've been solid. They've actually been pretty good, and the market's been responding in kind to that. I don't think they're good enough to justify huge moves up in the market, but they've been good, a little bit better than average even, so that's good. We've had some economic data that's been okay. We had a better manufacturing number this week. We had a weaker service number, and our economy is mainly based on services. And it was the worst number we've seen on services since last April. We also have seen some things in the continuing jobless claims are concerning. The weekly claims were just slightly ahead of what was expected, but the continuing claims were quite a bit higher than expected. And that's something that we keep our eyes on. Continuing claims can kind of lead into the employment numbers rolling over. So we watch that pretty close. And then next week, we've got a ton of earnings. I mean, just a boatload from all different industries. And we get Boeing and GM and Facebook and Microsoft and Amazon and Apple, Caterpillar, Chevron, Comcast. I mean, just a big mix of all kinds of different companies. That should give us a lot more insight on maybe what's going on in corporate America as those things come out. And the Federal Reserve has a big meeting next week where they will decide what to do with interest rates, hold steady, cut or raise. My money says they're going to hold steady because there are other indications on inflation that continue to be a little concerning, okay? We had some more this week. They're not the traditional numbers that you hear about, the CPI, PPI, things like that, but on the wholesale level, business type of surveys, et cetera, there's some concerns a little bit about inflation pushing higher. And I'm not sure what the Fed's going to do about that. I mean, they indicated last time that they were probably going to be taking it much, much slower moving forward. And my guess would be doing nothing. So we'll see. We'll see how all that plays out. So a lot to move markets next week in regards to earnings and the Fed. We'll watch how it plays out. I like where we sit. I mean, look, Europe is killing it this year, man. Europe is on fire. And you may recall we made big changes in week 1, pulling some money out of the U.S. and adding it to Europe. And I've been very pleased with that because Europe is killing it. I think that can continue. And we'll look for opportunities where they may come about as things get moved around and volatility picks up, et cetera. So I'm going to go and wrap up. Between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's run for public office because it takes a lot of money nowadays to do that. I'm not interested in that job, but hey, go for it. Hey, maybe it's buy that second house, take that big trip, retire a little early, or just plain retire comfortably. That's nice, right? Hey, you know what your goals are. Don't just think about them. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.